A 3% mortgage rate feels impossible to give up, but we recently saw a scenario where a homeowner moved into a higher rate and still came out with a better monthly cash flow. It sounds backwards, but once you look at the full picture, it starts to make sense. Hi, I'm Joe Harris, and I'm here with Mary Cables. Mary, how you doing?
I'm doing great. How are you?
I am very good. So Mary's one of our top loan officer and one of the top loan officers in Brevard County. Mary, this was a scenario we're talking about today that happened to you, or I should say, you made happen. Does that make sense? Yeah.
Yes.
So walk me through this scenario a little bit. How did you come across this scenario? How did it come about?
So, as we stay in touch with all of our past clients, so I always say to my clients that you're stuck with me for life. I'll reach out semi-annually, and as part of follow-up, a past client had mentioned that they had started to rack up some credit card debt. They needed an AC on the house,
Ooh.
and so there were some expenses coming up.
So it was a client we'd worked with before. They had gotten a loan through us a couple years back, and probably in the 2021 heyday where
Yeah.
rates were in the 2s and 3s. And what was their rate when you talked to them?
3.625.
3.625. So a really, really historically speaking, unbelievably low rate.
Yes.
But they had a financial situation, right? They had some debt. It was a credit card debt or all kinds of debt.
Credit card debt. There was also a vehicle that they were hoping to not have to make such a large payment to, and an AC that was needed.
Okay, so this specific situation, they were under a cash crunch.
Yes.
So they had some high interest debt, but they had a lot of equity in their home.
Yes.
So when you initially reached out, what was their purpose? Like, what did they want to do? Or did they even want to do anything?
They were contemplating on selling, so we had multiple discussions about that. But ultimately, what it came down to is they were really happy in the house that they were in currently, and so they wanted to stay in it, but they were looking, how do we stay in it?
Okay.
They were feeling overwhelmed.
And the debt was racking up.
Yes.
Okay. Obviously, what we're going to talk about right now isn't for everybody, right? That disclosure, it's, a lot of people, this type of situation is for people to get out of a situation and not get back in it, right?
Yes.
So we look at the whole financial picture. So walk me through, what did this look like when you went through it? How did they end up with better cash flow?
Well, I think like anyone's first reaction would be rates today versus rates before.
Right.
Stop it. This
Right.
makes no sense. So I went into the conversation knowing what they were looking to do. And I, in my head, was like, doesn't make any sense. We're not doing this. But as we started going through exactly what was needed, it actually made complete sense. With the compounded interest on the credit card that they were paying, they couldn't catch up.
No.
It just kept adding and adding and adding,
So the credit card debt, let's say it was at 20, 25, 26%. I mean, it was outrageous.
Yes.
And then they had a lot of equity in their home.
Yes.
So a lot of people think, why would I refinance? My rate's at 3.625 and the rates are at 6.5. So tell me how it made sense for them.
How it made sense was they were, through conversation, because the last thing you'd want to do is to take from your equity to then get yourself into credit card debt again.
Right.
So they're done with racking up credit cards.
They cut them up.
Cut it up.
Right.
Put it in the freezer. Ice it. So they, through conversation, they were done with it. They were just looking for a way to manage their finances more responsibly. How do we get ahead? We want to start saving. So through the conversations, realizing that it not only was going to help them with the credit card, but also the AC that was needed. Have you seen prices of AC?
Yes,
lately?
I might have to get 3 new ones right now. Like
Insane.
2 big ones, 1 small one.
How much is that going to cost?
A lot.
What's your interest rate on your mortgage?
Low.
Might make sense. Let's talk later. With conversations, with going through everything with him, realizing that not only being able to pay off a vehicle with their monthly expense, not only paying off the credit card, but also giving them the ability to pay cash for the AC and not have to take out another credit card or finance it a different way, getting out of credit card debt, it truly made sense as far as a monthly cash flow perspective.
So you're looking at what their old monthly payments were for the house, the credit cards, the car, everything. And then you're looking at, hey, if we refinanced all those back into the mortgage, even though we're going for a higher rate on the mortgage at 6%, 6.25, somewhere around there, versus the 3.625, when I put all that debt into the mortgage, even though I'm paying for it over, I might pay more in interest over the life of the loan, I'm stuck in a situation. Only way out is to sell the house, right? And pay off the things. But now I still got to buy a new house at 6.5%, whatever the rates are at the time. So it made sense in this scenario to wrap it all into that mortgage. And then now your total monthly payment on all the debt is all paid off, and you have a $400 increase in cash flow, and you have money for the AC.
Exactly. And so all of the things added. Yeah.
But this wouldn't be recommended for someone like, I look at the equity in your home as a last resort in a lot of cases. But even at 6%, I mean, geez, think about that. Even at 6%, you've taken the money out, you're paying it back at 6% in today's dollars. And over time, we know that in a couple of years, a dollar is not going to be worth what a dollar is today. I mean, think about 10 years ago, you could buy a hamburger at a fast food joint for $1. Now that same hamburger is $4, right? What's it going to look like in the future? So you're locking in today's dollars for paying off debt over the course of the future, when that money is going to be hopefully a lot easier to come by because of inflation, right? So what advice do you give to people that are thinking about this, or have a lot of credit card debt and have equity in their home and things like that?
So call me or a loan officer that you trust and talk through the potential scenario, because feeling like you're jailed to this mortgage, which is what I hear over and over again. I feel jailed to this 3%, 3.5% interest rate. So, puffy jail, but not jail nonetheless.
Right.
But I feel tied and obligated to this, but in the grand scheme of things, maybe it could potentially save you in the long run by doing something like this.
I think there's a lot of potential for people to, like a loan officer, to make a situation look good that's really not good. So what are things that borrowers, applicants should look out for when looking at this type of situation?
Well, budget, figure out exactly not only what your current budget is, but what you would like for your future budget to look like, so that you can understand if this is truly helping you or not. Old rule of thumb used to be, oh, you got to save 1% for it to make sense to refinance.
Right.
But I've had so many conversations with clients where it's like, your loan amount being $200,000, you save 1%, with all your closing costs, it doesn't necessarily make sense.
Doesn't make sense.
Understanding all of the numbers, not just one piece of the puzzle, to know if it makes sense or not.
Right. And other red flags, if they're talking to other lenders out there, what are some of the red flags that they might look out for? They might be in a situation. When does it not make sense to do what you're talking about?
Well, if you're, not only having all of these, you're paying off things, but not necessarily saving. So if you're paying off a credit card, but then ultimately, it comes out to where it all breaks even at the end,
right,
and it doesn't necessarily make sense, then you have to take a second look. Is your APR much higher? Are there a ton of fees that are involved as well,
right,
to where it's being rolled into the back end, to where you're not necessarily understanding in the grand scheme of things how much you're taking away from the equity in your home? If you're planning on selling in a year and you could potentially use that equity to pay off the debts
anyway,
then,
right?
Why would you do it then? So there's a lot of key factors that you should look out for, but those are probably the main ones.
Cool. Well, a lot of times it doesn't make sense to go from a 3% to a 6%. And I think we've uncovered a place where where if you take a look at the total debt picture before the refinance and after the refinance, is there a true benefit there, is I think is what you're saying. And what's the cost to get that benefit? And does it make sense for me? Am I going to be in the house long term? If I'm going to sell in a year, or, it's not going to make sense. So very cool. Any parting words out there, Mary?
Well, and also, if you're not going to make any changes to your lifestyle. So if you're going to do the refinance and then you're just going to go right back to racking up credit card debt again, and you're taking away from your future equity. So you also have to take a hard look at what your entire lifestyle is, and make sure you're adapting to those changes to make sure you're not going to get yourself in the situation again. So
awesome.
That would be it.
Awesome words. Well, thank you very much for joining us today. I learned a little something, but if you have any questions, comments, concerns, or otherwise, put them down below. We'd love to hear from you. And if you need a great loan officer to give you a good loan and or a good evaluation of what you should or should not do, call Mary. Her numbers and the contact information down below and in the description. Thank you again. Like, subscribe, and share. We'll see you next time.